got lots of housing updates today. We've got sales, price, inventory, rent. We can talk about what the Fed is talking about and even give you a color on the Fed calendar to kind of estimate when a rate cut may occur. We've got lots of folks talking about a rolling recession or maybe a K-shaped recession. These are all topics we have been talking about for quite a while. But first and foremost, special shout out to Anna Kelly. Anna Kelly obviously is a returning guest, but she was a part of our school community yesterday. And she covered amazing topics like what to do to get prepared for a recession. We talked about home prices, and we even answered student questions. So again, folks, if you want to be a part of the school community, I'll put a link below. Our next special guest for the school community will be the one and only Dan Bird. A lot of you want to talk stocks. You want to talk charts. So we're going to bring Dan Bird this Sunday, 10 a.m. Pacific, which is our normal scheduled time. So if you want to talk stocks, index, ask Dan any questions, you will have that opportunity in the school community. Again, I'll put a link below. Let's talk about sales. U.S. existing home sales came out this morning. And if I had my swing and a miss shirt, I would be wearing it this morning. It did not come in as I expected. Here are the numbers. Last was 4.19 million sales, just a tick below 4.2. Expected 4.23, so expected to go up. I actually expected to go up more. I expected us to exceed expectations again. And alas, it did not happen. Came in at 4.14. What does it all mean? Well, I think it simply means rates matter. Something that I failed to acknowledge when I guessed where sales would go is much of April, we were close to 7.5% interest. So again, we were at the high end of the range, which clearly, if you've been following the channel, pulls back demand. We're going to see what happens going forward because obviously we have ticked below 7%. I have had people call me and say they are getting quoted 6.5 with a point or a point and a half. So we're going to see, does marginal demand come off the sideline? So again, sales disappointed and I was wrong. Next up, price. We've been hearing about a price crash for 5 years. Well, it still has not shown up. Home prices, median home price, $407,600. That is actually up 5.7%. Hard to call up 5.7% a crash, but undoubtedly some of them will. We are seeing the impacts of higher interest rates. We are seeing inventory rise. Inventory was actually up 9% month on month. That is actually up 16.3% year on year. We are now sitting at 3.5 months of supply. Folks, this is good news. No. This is great news. What have you and I wanted for years? We want a slower housing market. How does a slower housing market show up? Well, days on market rise, inventory, months of supply rise, inventory rises. So again, I am excited. We are finally getting the slower housing market that we have been discussing for years. If you are in the course or in the community of one rental at a time, this is time to double down on your buy box. Set up your criteria, maybe with 30 days on market like Dion did, and write disrespectful offers. Remember, folks, I think Dion wrote an offer for 20% below list price for a property, a duplex that had water views. Have you seen those pictures? Crazy. So again, this is what we want. We want a slower housing market because we want to be rewarded for doing the work. So hopefully you see all of this as good or great news because I do. What about rent? Remember, folks, inside CPI, I think rent was still about 70 or 65 or 70% of inflation. Remember, we've talked about rent being the only lagging indicator inside CPI. It's not real-time information. Well, according to The Real Deal, rents in April, this is across the board, were down 0.8%. Now remember, if CPI is up 5 and the actuals are down 0.8, let's round it to 1 so it's easier math, and we have shelter inflation coming in at about 35% of CPI, it's not hard to get to 2% simply by replacing a lagging and miscalculation of shelter with actuals. So again, pretty interesting. But it is also very important to note, given this channel's focus on residential properties, that all rents are not equal. The 0.8 number is a collection of all rentals. If you just look at single family homes are up 3.4%. Now again, these are national. These are not, city by city. If you're in Austin, for example, rents are down 3.5%. If you're in Seattle, rents are up 6.3%. So again, the highest up 6.3% Seattle. The most down was Austin, Texas, 3.5%. Let's talk about what Altos Research brings us. Altos Research, Mike Simonson gives us all kinds of stuff. Price cuts. Price cuts are actually up 34.4%. That is above normal. I believe normal is 34.1%, so slightly above normal. Inventory week on week's up 1.7%. Again, that is good news. It's actually up 36% year on year. New listings up 5% year on year, and pending home sales down 6%. It will be interesting to watch pending home sales as we roll forward the next couple of weeks to see if rates below 7 pulls that marginal demand off the sidelines. Got an interesting article from a follower, Chester. Chester, thank you for sending me this. Folks, I'm going to read you 6 cities. 6 cities. This is crazy. 6 cities where the mean income is $300K or higher. Los Altos, California comes in at number 1, where the mean income is $400,000. If you're not making $400,000, you're below average in Los Altos, California. Next up was I'm going to go Wesley, Massachusetts, $367,000. McLean, Virginia, $364,000. South Lake, Texas, $360,000. Saratoga, California, $329,000. And Menlo Park, $316,000. Folks, that sounds crazy, but I got to tell you, there's a lot of people living in those 6 cities that are living check to check. Folks, it's expensive to live in those cities. How expensive, you ask? Well, let's talk about housing. If you think about all the Crash Bros, one of their favorite charts is to show you income to price, which of course, as I've documented many times, is a crap chart because it misses interest rates. But let's just use the Crash Bro chart. Across the country today, the average is 4.2x. So income times 4.2 equals home price. If you were in one of these top 6 cities, you know what your ratio is? 10x. How about that, folks? You make $400,000 in Los Altos, California, and you can't afford a median home. Wild to think about. We've got more data from Fed speeches, and I think we're really getting a clear sign of what the Fed wants. The Fed wants more data. The Fed wants confidence that the April reading of CPI and likely PCE is a trend. So I want to give you the Fed meetings the rest of the year, and I want to ask you, which meeting do you think the first Fed rate cut happens? Alrighty, folks, the next Fed meeting is June 11th and 12th. Does anybody think June 11th or 12th will proceed with a rate cut? Let me know below. Probably not. If you're watching this channel, you probably know that there's no chance for a June rate cut. But now it gets interesting. After that, we have a July meeting. July 30th and 31st. Could we have a July rate cut? Maybe. Let me know in the comments below. How about after July? Maybe July is that third month, right? They want more data. After July, we go to September. September 17th and 18th. That is the last meeting before our election. Let me know if you think it will be September. And then after that will be November 6th and 7th. November 6th and 7th is the same week as the election, but actually after the election. I think the election will occur on November 5th. I think the election's Tuesday, November 5th. And just to round out the schedule, if it's not November, it will be December 17th or 18th. So folks, let me know in the comments below. Do you think the next rate cut, or I'm sorry, the first rate cut is June, July, September, November, or December? Again, folks, I think I've thrown it out there that it is my hope there is no rate cut before the election. I would like the first rate cut to occur in November or December. But again, I am not one of the 19 people voting, so we will see. Again, let me know what you think below. We did get Target's earnings today, and as expected, Walmart kind of called the shot. Remember, Walmart said we are getting more high-end consumers, which is code for taking market share from Target. Yes, folks, sales at Target were down 3%. Consumers are buying fewer everyday items. You know what that means to me? They're shopping at Walmart. Also, continued soft trends in discretionary categories. So, folks, I think we heard yesterday, maybe the day before, that Target is going to whack the prices on over 5,000 items. This is what happens in a slower economy. Retailers are forced to cut to continue sales. What else do we have? Again, we got more and more people talking about a bifurcated economy, which we have been talking about for years. We talk about the bottom 75 and the top 25. Remember, I believe it's the top 30% of consumers are 60% of discretionary spend, something like that. So again, this is what is occurring. We have people talking rolling recession. We even have somebody calling a K-shaped recession, where the bottom is in recession and the top is not. I still am under the impression that we are in a rolling recession. It will continue to distract economists who are used to everything going down and coming back. To that end, why do I have a little bit of confidence about a rolling recession? Well, I bring to you today's mortgage data. Remember, folks, mortgage and really real estate transactions have been in a depression. We have seen a 50% drop in transactions, roughly. So that's depression level. What happened today? And it's actually been going on the last 3 weeks. So we now have a trend, not a single data point. We are seeing refi demand increase as rates come in. Refi demand was up 7% week on week and up 21% year on year. Think about that. You're up 20% year on year. Now, again, we are coming from stupid low levels, but this is what a rolling recession is. You go into a depression and then eventually you come out of it as other sectors contract. That is a rolling recession. Last thing, there was a survey by Santander Bank. Probably mispronounced that, but I gave it a shot. 62% 62% of consumers are making a significant cut to household spending. Folks, I've said it many times and will likely say it many more. The consumer is roughly 68% of the economy. And if we truly have, if it's true, not just words, because we know consumers lie, if 62% of consumers are pulling back, we will have a recession. No question. No question. On top of that, we have 60% of U.S. consumers believe we will be in a recession in the next 12 months. So, folks, at the end of the day, I want you to be encouraged. I know the headlines can be scary. I know that there are content creators out there that their sole job is to scare you. I am not one of them. I want to bring reality. I want to encourage you. I want you to understand that great opportunity comes from great pain. I want you to understand that you and I have been begging for a slower housing market. It feels like we are getting it. So again, I want you to understand now is the time to do the work. Now is the time to get in communities with others that are doing the work. You need support. You need encouragement. You need to make sure you're focused. You have daily discipline. But the next 18 months could be really good for us. We've already talked about Ken McElroy buying $500 million. We've talked about Grant Cardone buying cash. The opportunities are coming. Please, you can't get ready when they're here. You need to get ready now. The process that I teach about learning your buy box is a 90-day process, best case. For lots of people, it's 6 months. Folks, time to do the work. All right, folks, take care of yourself. Have an amazing day. Remember, join the school community, and you can participate in this Sunday's session with Mr. Dan Bird, and we will continue to do sessions each week. Once we get to 100 students, we will actually keep content just on the school platform just for you. Today, we're at about 30 students. So we should get to 100 here shortly. And when we are there, we are really going to start to provide more and more unique value. Folks, take care. Have an amazing day. Later.